Welcome to Dr. Fred Markets. This is not financial advice. The gap between those who understand finance and those who don't is growing every year. Markets, crypto, artificial intelligence, they just require attention. You showed up today. You're on the right side of that gap. Let's make it count. Let's go.
Heat waves are turning dead bodies into cash flows for people who read footnotes. France just reported over 1,000 excess deaths from the latest heat wave, while Europe logged its hottest Junes on record 3 years in a row. Behind that horror show, Swiss Re's latest report pegs global insured natural catastrophe losses at roughly $100 billion per year, now a new normal instead of a once-a-decade freak event. And while your newsfeed cries about climate anxiety, BlackRock quietly raised over $1.2 billion for new climate infrastructure debt funds that get paid before equity when things go sideways. Here's what no one tells you. Extreme heat is not just a tragedy. It is a measurable, tradable financial factor. Weather is now a line item on institutional P&Ls, with heat indexes and degree days priced into contracts the same way interest rates are. The Paris heat wave is not unprecedented to markets. It's a stress test that ratchets premiums, reprices land, and separates losers from people who know how to read a risk table. Signal 1, the rise of heat risk as a hard number. Real estate analytics firm First Street mapped U.S. heat exposure and found tens of millions of homes facing at least one feels like 125-degree day per year in the coming decades. Insurers already translated that into higher premiums or canceled coverage outright in parts of Florida and California. That's not politics, that's underwriting math. Actuaries saw the curve and said, nope. The market's answer to uninsurable heat isn't a hashtag, it's pay more, move, or burn. Signal 2, cities are quietly turning shade into an asset class. Look at the budgets. Paris pledged around €1 billion to cooling infrastructure for the Olympics and beyond: trees, reflective roofs, shaded walkways, cooling centers. U.S. utilities are filing rate cases that include grid hardening and upgraded transformers because air conditioners turn on like a wall of demand during heat waves. Every upgraded substation, microgrid, and thermal storage tank throws off regulated returns. You pay the bill. Regulated utilities and infrastructure funds get the yield. Signal 3. Water just became the choke point that ties heat to cash flow. Heat waves spike water demand while reservoirs drop. Water utilities pass on the cost of new desal plants and pipelines through long-term inflation-linked tariffs. Private capital loves that, boring, contracted, and mostly uncorrelated with meme stocks. Your shower is someone's fixed income product. So here's the cliffhanger. While headlines scream about heat deaths in France, the actual trade isn't Europe at all. The edge hides in how investors treat weather like an index, and in who owns the pipes, wires, and chillers that let rich cities stay livable when everyone else cooks. Here's the connection the talking heads miss. Extreme heat turns three things into money machines: insurance pricing power, regulated infrastructure, and data. Reinsurers push premiums up after each heat wave. If you're on the capital side of that, through insurance-linked securities or catastrophe bonds, you get paid to absorb weather risk that freaks everyone else out.
Does what you just heard make you want to learn more, to dig deeper, to ask better questions? That curiosity is exactly what separates people who understand finance from those who don't. Most people stop at the surface. You're going further. Let's continue.
Infrastructure funds own the very assets governments must upgrade: distribution grids, district cooling, water treatment, and reservoir systems. The more the mercury climbs, the more non-discretionary capex they're allowed to dump into their rate base, and the more regulated return they book. Now add data. Climate analytics firms that quantify parcel-level heat risk are becoming mandatory vendors to insurers, lenders, and city planners. They turn thermodynamics into FICO scores for buildings. That data does not care about your politics. It cares how many days above 35 degrees Celsius a transformer survives before it pops. Banks look at that and adjust mortgage terms. REITs look at that and re-weight portfolios. That is how heat silently moves money. Here's the single mechanism you need to understand. Heat doesn't destroy value uniformly. It redistributes it from open-ended, unpriced risk to whoever owns the choke points of adaptation. Every time an insurer refuses to renew a policy in a hot zone, the utility that sells more power for air conditioning and the water company that builds another treatment plant step forward. Every time a city commits to cooling centers, a boring infrastructure fund lists another line in its prospectus. So what do you do with this information without turning into a ghoul trading body counts? 1. Read the damn risk disclosures. Any utility, water company, or infrastructure fund that talks explicitly about heat adaptation, grid hardening, or water stress in its 10K or annual report is already in the game. Vague ESG fluff is useless. You want numbers, CapEx plans, regulated returns, and specific adaptation projects. 2. Treat weather as a portfolio factor, not background noise. If all your real estate exposure sits in high heat, high water stress regions, and you own nothing in regulated utilities or water infrastructure, you're not indexed, you're naked. Spread climate risk across geographies and include at least one boring cash-generating name that literally gets paid when the AC never turns off. 3. Learn one new tool, degree days. Cooling degree days, CDD, are how utilities and energy traders model heat-driven demand. You don't need a PhD. You just need to know that rising CDD trends in a region usually translate into higher peak power demand, more grid stress, and more justification for expensive upgrades that regulators let utilities earn on for decades. This is not financial advice, but here's the truth. Heat is now a financial input as real as interest rates. Ignore it, and you donate returns to the people who don't. Use it, and you stop being the product of someone else's weather model. 3 quick takeaways. 1. Extreme heat is now explicitly priced into insurance, utilities, and water check the filings. 2. The profits don't sit in headlines. They sit in the pipes, wires, and data scoring who gets cooked. 3. Start tracking where your money sits on the heat map and add at least one asset that profits from adaptation, not denial. If you learned one new thing today, hit subscribe. Tomorrow we find the next boring disaster the market turns into a yield machine. This is not financial advice. If you enjoyed this video, please subscribe to the channel and check the links in the first comment below.
That's it for today on Dr. Fred Markets. I hope this gave you clarity and a new perspective. Remember, this is not financial advice. Always do your own research. If you found this useful, subscribe. It's free and it helps the channel grow. Find me on the blog at drfredmarkets.com and join the newsletter via the link in bio. I'm Dr. Fred Markets. See you in the next one.